Okay, Marty, take it away.
Thank you, Maddie, very much. And thank you, Carolyn, for the questions I know you're going to ask me as we go through this. We've done a number of these, and this is part of what we'll call the Clock is Ticking series, because it is a countdown until the 2020 ERCs are no longer something for which a taxpayer can apply. It's a little less than a year, and then a little less than 2 years for the 2021. But because we get so many inquiries about employee retention credits, and because there's so much bad information out there about the employee retention credit in terms of who qualifies, or that the rules have changed, or that I don't even know, there's so much advertising going on with respect to ERC. Our goal would be to cut through the noise for anybody who is who's come in for this particular podcast webinar, so that we can talk to you about our experience. Both, we'll give you the basics about like what it takes to qualify, but I have a feeling that most people on this podcast have a decent idea, or they've heard about this thing, or they might not be here. I want to, again, as I said, sort of cut through the noise and the misinformation that's out there. And so again, we'll go through the ERC background. We'll go through what we'll call required documentation. This is where we're going to focus a little bit today. It's maybe a misnomer to call it required documentation, because you file a 941X and you're really not filing anything other than your tax position. But what we can give you is our best estimate of, even if you do qualify, if you don't have the documentation to support it, it's going to be difficult to convince an IRS agent that you do. And also, I can give you an idea of some of the other bad studies that I've seen out there and positions that are taken that are really, I would say, like raising the ire of the IRS, and what to avoid. So that's importance of documentation, required documentation, and our approach to clients and how we can help. So let's go to the next slide. Cool. Polling question 1. How'd you hear about this webinar? A Cherry Bekaert tax advisor. B, email from a Cherry Bekaert. C, friend or colleague. The next one is Cherry Bekaert alum, or a social media post. We've been doing our best to reach out to as many people as possible. We know there's quite a bit of advertising around the employee retention credit. And so however you heard about it, we appreciate you being here. It's been a wonderful opportunity the last 2 or 3 years to get to know so many clients out there who are not only interested in employee retention credit, but then we can also help with respect to some other areas like R&D, et cetera. Okay, so email from Cherry Bekaert. So this means we're doing our job very well. I guess we're reaching out to people and you're responding. So I definitely appreciate you guys being on this call. So let's go to the next one.
Oops.
That's all right. I probably have them memorized. If you can't do it, I can do it all from memory. All right. So let's talk a little bit about the employee retention credit rules. As we know, this is a payroll tax refund. It's partially a refund of the payroll taxes you paid. It's partially, we'll call it a stimulus on top of that, because it's calculated not based on what you paid in tax, but rather what you paid your employees over a period of time while you're eligible for this credit. There are 4 credits. There is one for 2020, specifically for the time period March 13th through December 31st, 2020. And then there are 3 additional credits, one for each of the first 3 quarters of 2021. The 2020 credits are less generous than the 2021 credits, and sometimes more difficult to qualify for, at least under what's known as the gross receipts test. There's 2 ways to qualify for these employee retention credits, as I'm sure you know. One is to show either respective 50% or 20%, more than 50% or more than 20% decline in your gross receipts in the quarters of 2020 or 21 compared to the exact same quarters in 2019. We always compare back to 19. I've found that to hit a 50% decline in 2020 is difficult. Not that many companies do that or can qualify that way, but to hit a more than 20% decline in 2021 compared to those same quarters of 2019 can be a common occurrence. It's just important to have your gross receipts documented appropriately, commensurate with your method of accounting for tax purposes. The other way to qualify is to show that there are government orders, specifically COVID-19 related specific government orders limiting what's known as commerce, travel, or group meetings, limiting the operation of a business directly. We've seen, and let's talk documentation right now. I have seen consultancies say, look, there's OSHA guidance and there are CDC guidance out there. That's a government order. It isn't, at least not for purposes of the way the IRS is going to accept this. They were in place long before COVID was there. If you have done a study where you're relying completely on OSHA or CDC guidelines, take another look to see if you actually qualify for this credit, because under that theory, everybody would qualify.
And Marty, that's a really good point. There are some states that
Yeah.
have codified OSHA and CDC guidance as a government order. So it's not just that it exists. There are states that have governmental orders that say incorporating by reference CDC and or OSHA guidance. So,
and they did it specifically for COVID-19 purposes, which is important. It has to be COVID-19 specific. Yes, that's a good point. Sometimes you can rely on it, but it depends on the state, and it isn't that many of them. The other argument that you'll see is, and this is originally in one of the FAQs, to the extent, like say, for example, a essential business, and so therefore many of the government orders did not apply to you. But up your supply chain, there was a government order on your supplier. What we have seen, and we have used the supply chain argument because it is valid to the extent there is a government order on your supplier causing a disruption to you, and you can trace that down. But what I've seen in some documentation is, yeah, there was a lot of supply chain problems out there. Everybody understands that's enough, therefore I have it. It's been that bad in some of the things that I've seen, and the IRS is not accepting that. They're going to go hard after these supply chain arguments that don't identify the supplier, identify the duration of the supply chain disruption, identify why it's having an impact on a more than nominal portion of the business, and identify the duration of that order and who issued it as well. So that is the approach that we've taken. You can find some orders, US and foreign potentially as well, that are having true disruptive effects on a supply chain. The issue then is showing that it's having an effect on a more than nominal portion of the business. The hardest argument you're going to have is for a company that is having increasing sales and gross receipts well beyond the rate of inflation. And yet saying they've had these supply chain disruptions that are causing a disruption to their business. You can find it. You can find a particular, perhaps a business line within the organization that is affected. And if it's more than 10% of the business, then potentially you have an argument. If you can trace that, and if you're a small employer, maybe you can bring in all the employees, but there's a lot of work that goes into it. My point here, and this again, is documentation. And we'll get to this later, so we don't need to switch the slide, but you have a lot to do when it comes to documentation. What are my thoughts on foreign government orders and supply chain disruptions? My thoughts are that technically they qualify. And we have a firm position that they do. That was a question that just came through in the chat. You won't find it specifically stated anywhere in the FAQs or the IRS orders, but you also will not find it specifically stated that they don't qualify. Both at my Big Four firm before I came here and here, we were of the opinion that the government orders issued by a foreign government were valid for purposes of causing a disruption, much in the same way that a controlled group overall, to the extent it has foreign operations, has to consider the foreign gross receipts as well. You're only looking at US employee counts, but our firm position is on that the foreign orders will qualify, and you'll see a number of them specific to ports, specific to shift changes on ships. Sometimes it starts to get a little too deep when you're talking about specific supply chain disruptions on steel and things like that are causing Maquiladora, Mexico. Yes, also Mexico is a location that had a number of red, green, yellow designations specific to how people could and could not work that caused massive supply chain disruptions in the US. We have utilized Mexico as well. But again, identify supplier, identify the timing, identify the specific state in Mexico as well. All right, I'm tripping around here, but I'm going to go back to my main point here. You find gross receipts arguments more common for the 2021 credits, and the government orders arguments more common for the 2020 credit, because the orders are more prevalent in 2020. The issue when you switch that, and in 2021, you're utilizing more of the government orders, especially as they start to get lifted through 2021, that will open up potential scrutiny from the IRS unless it makes sense with respect to your organization. But
Marty, will you address reduction in productivity? I know the IRS addresses it in their FAQs, but I'm still seeing arguments when I'm reviewing other providers' work that address reduction in productivity. Talk about that.
you can, and I don't want to confuse two separate things. So there's a reduction in productivity anti-argument, and we'll get into it. So for example, if you are a large employer, and which means that you have more than 100 full-timers in 2019 or more than 500 in 2019 for purposes of the 2020 and 21 credits respectively. That means you can only include wages you pay to people who basically you didn't fire and you didn't throw them off onto unemployment. You kept them on the payroll. Paying them a full day's wage, but them just being less productive because they were working from home does not mean that you were paying them not to work. You were paying them to work. They just happened to be less productive. For the small employer context, when we talk about the overall effect on an organization and supply chain disruptions and having some amount of productivity in there, that may be a sprinkle of something you want to talk about a little bit on an effect it may have on an organization, but you're really focused on how supply chain disruptions, supply chain disruptions can cause productivity delays to the extent you can't get a piece of machinery in. And so therefore you have to do things more manually by hand or something like that. And so that's causing a disruption that way. And so your productivity may be lower because you don't have the supplies to get it done the way. So I know what you were going for on that question, which I think was a large employer one, but productivity can be an argument when it comes to defining how you're having an effect on a more than nominal piece of the business. Everything is facts and circumstances in this. So
and document. Right?
Absolutely. Very good question. And no one's asked me that way. I got to answer it twice. So thank you. All right. So partial suspension definition here. Okay. We want to show that a government order is having an effect on not just a very small piece of the business, but on something that's substantial. And so what they refer to is a more than nominal portion of the business. And the way they define that is a portion that in 2019 generated gross receipts of 10% or more in a particular quarter, or 10% or more of the hours associated with the business were associated with that activity. Sometimes you can see organizations that change what they do later to adapt to COVID. And so they might have some additional revenues coming in because they started to make PPE or something else. But compared to 2019, what they normally would be doing in their normal operations, they can do less of. That might be an argument to show. But really, it's great to show hours associated with a particular activity or trade or business, or revenues associated with particular line or trade or business as well. And if you can have that in 2019 and show how the government orders are affecting that particular more than 10% area of the business, that will be enough to show that it's having an effect on more than nominal portion of the business. So that's what we're talking about with partial suspension. But again, even if you have it and your gross receipts are growing like crazy, you're really going to have to document it and prove it to the IRS. Let's move to the next. All right, polling question 2. Was your business impacted by a government shutdown, COVID mandated orders? Yes, no, or unsure. What I have found is that some places didn't really realize the effect that these government orders were having on their business, specifically when it was up into the supply chain coming down and affecting the business, or just as they walked through COVID, they were so focused on getting their PPP and getting everything else done that they didn't really have time to focus on this stuff. So sometimes in retrospect, you know better as to how these government orders were affecting you, especially as they're lifted. All right, yes, and then no. But again, if it was on your customers, you might be able to say that you had a gross receipts decline. If half the people did say they had some kind of effect directly from a government order, I would suggest, if you haven't claimed the employee retention credit, think about it. We're more than happy to talk to you. Okay, let's go to the next one.
Oops. Oh, this is on me.
Oh, that's fine.
Oops.
And I do like your questions, Carolyn, so feel free to keep lobbing them at me, because it does make it, everybody's heard about ERC, but it is interesting to go through and talk a little bit about some of the nuances and the stuff, especially when we see it day to day. Okay, ERC and gross receipts. One of the questions I get is like, can tax exempt entities qualify for the employee retention credit? Yes, they can. This is really employer focused. And so outside of the specific prohibitions for certain governmental entities, both nonprofits and taxable entities can qualify due to declines in gross receipts. And what we have seen for a taxable entity, the definitions are a little bit different than they are for a tax exempt entity, specifically around sales of assets like stock. It's the entire gross proceeds that are treated as the gross receipts, as opposed to just the gain on the sale, as it would be for a taxable entity. So there are different rules for taxable and tax exempt entities. But the most important thing to keep in mind is that gross receipts for this purpose, it's not necessarily the money you got. It comports with whether you're an accrual accounting for tax purposes or cash. Whichever of those methods you're on, that's the method you follow. And it's not just your sales. It's also the amount of things like dividends, interest, rents, royalties, and other income items gained from the sale of assets. And so, for example, there's some specific rules for companies that didn't start, let's say, until mid-2020, the recovery startup rules that would allow you to potentially qualify for an employee retention credit in quarters 3 and 4 of 2021. But if you made like $100 of interest income back in 2019, before you really got your operations running, technically speaking, you wouldn't qualify because you can't have gross receipts until like mid-February and on in 2020. So just small amounts like dividends, interest, rents, royalties, and things just accruing into a bank account that was set up actually qualify as gross receipts for this. So that's a very important test to think about when you're thinking about if you do or do not have a decline in gross receipts and when the first period of gross receipt generation occurred. All right.
I think we've probably answered this and everyone's aware, but I'll ask it. Is PPP revenue included in gross receipts for the ERC computation?
Thank you for asking that question, because I would have skipped over it. The answer is no, but we thought yes at first. And so a little history here is important. When the ERC first came out, if you got a PPP loan, you were automatically statutorily disqualified from claiming an employee retention credit. That later changed on December 27th, 2020, such that you could claim both. You just can't utilize the wages from PPP funding in an employee retention credit. But generally speaking, that's not going to necessarily reduce your benefit too much. But we were unsure as to whether or not the amount of forgiven PPP would qualify as gross receipts for purposes of the employee retention credit. And for a long time, we were treating it as if it were. It was not until August of 2021 that the IRS came out with some clarifying authority that neither PPP forgiveness, shuttered venue grants, or restaurant revitalization funds were treated as gross receipts for purposes of the employee retention credit, a very, very taxpayer favorable ruling, which then caused many taxpayers to go back in time and take a second look. What I will also tell you is that is just about the last time the law changed, August of 2021, with respect to the employee retention credit. And one of the things I wanted to hit on this particular webinar is all these ERC mills and extreme advertising telling you that the rules have changed and now you no longer need to have gross receipts to clients. Well, the rules haven't changed, not since August 21. And primarily speaking, the rules really haven't changed that much since the thing came out. The only thing that really changed was if you got PPP, you could later claim it. And there was clarification around some of the rules around some of these other programs not being treated as gross receipts. Beyond that, supply chain disruption stuff was always part of the original FAQs. It's just been vetted out more and more over time. But if you hear somebody telling you the rules have changed recently, or you're running out of time to qualify for the employee retention credit, I wouldn't suggest you work with them, because they're either trying to tell you something that's not true or they don't know the rules. So I will leave it at that. But everything leads to a nice question, Carolyn. Thank you. This is like my warnings for everybody who's getting these advertisements. All right. Qualified wages. This is the small employer, large employer difference. And again, small employers get the benefit of being able to include wages they pay to every employee in the employee retention credit, at least up to the first $10,000 for each of the 4 periods. But the difference between the 2020 credit and the 2021 credit is that a small employer for the 2020 rules is one who has 100 or fewer full-time employees on average. And the way you do that count is you look back into 2019, look at every individual person in every month who worked 130 hours or more, they're in the count. If they worked 129 or less, they're out of the count. And you do that for every month, add them up, divide by 12. Do the same thing again for the 2021 credits. And if the number is 501, they're a large employer. If it's 500 or fewer, they are a small employer. This is going to be critical for those that are on the edge. And there's also some very specific rules for companies that were acquired in 2020, where they may actually be able to use the 2020 employee count as opposed to the 2019. I'm not going to say too much more on that, but if you have a company that was acquired in 2020, I would be happy to take a look and talk to you about some of the nuances and the rules about how you do the employee counts in that year, also specifically when it's coming out of bankruptcy as well. So I'll leave that at that. But again, we're focused on how many full-time employees were in each month of 2019 at an organization. What I also want to say as well, when we are thinking about looking back into 2019 and doing a gross receipts analysis, and say, for example, the company was acquired in 2020, it is perfectly permissible and reasonable to include the pre-acquisition gross receipts in the number, because you're really following the trade or business and how it operated pre-acquisition and how many employees it had after acquisition during these ERC eligibility periods. The employee count stuff may not be required to do it until you get to the acquisition time period and post, but it's again taxpayer favorable. You're allowed to include the pre-acquisition revenues and gross receipts for a company. So if you had a company that on its face, when they bought an organization, seemed to be growing compared to 2019, you need to factor in the pre-acquisition gross receipts, because that will average things out and you may end up qualifying. You might not have known. The other thing to talk about here is what's known as a control group analysis. We see a very similar analysis when it comes to the research credit. The idea being for purposes of the employee retention credit, you are required to look at common ownership. And so say, for example, the same 5 or fewer individuals own multiple businesses in a more than 50% amount. You have to look at all those businesses together. And so what we're always doing is looking at who owns the organization. Were any of the owners who are more than 50% owners actually employees of the organization? If so, a more than 50% owner who's also an employer or the relative of a more than 50% owner generally doesn't qualify for the employee retention credit, due to the fact that the government did not want to give you an incentive to not fire your family because they figured you never would anyway. And so they might have figured wrong with respect to some of our families. But with that said, that's the method, that's the sort of logic behind that, is why family members don't get to take a credit on themselves. But anyway,
What about
yeah.
PE firms?
Very good. I was just going to get to it, but I probably was going to forget unless you said it. So I'm glad you did. Generally speaking, private equity is a rich area for the employee retention credit, due to the fact that there are a multitude of portfolio companies under the private equity fund. Originally, and potentially confusing it with some of the PPP rules, there was the concern that the fund would have to aggregate all of its portcos together, as it did its employee count and its gross receipt counts. So everybody would almost be a large employer. We are of the firm position, as are some of the other big fours. I believe they're all on the same page right now, that the PE, the fund itself, is not an active trade or business, and therefore really breaks the aggregation among the different operating trades or business portfolio companies. At least at that top level, the subsidiaries of the portcos would still be treated as part of the control group of the parent portco. But it's really important for any PE owned organizations to consider themselves almost as an independent organization and not necessarily as part of a larger group due to their ownership by a PE fund. So excellent question. We have worked with a number of both PE firms who want us to look at all of the portcos, or alternatively, just portfolio companies who come to us one by one and want to analyze what their potential applicability for the employee retention credit is. Okay, we'll leave that at that. Okay, so here's some stuff. This is just stuff to make sure that I cover it for you. As we covered, PPP forgiveness is not considered gross receipts for purposes of the employee retention credit. Now, the next thing, income tax offset. This is incredibly important. By claiming an employee retention credit for payroll tax purposes, you are effectively taking the position that you are not eligible to deduct the wages in the amount of this credit for the same year to which the employee retention credit relates. So for example, if I have $2 million of employee retention credits that I've applied for and I'm waiting for a check from the IRS, technically speaking, I should not have taken a deduction for $2 million of the wages for income tax purposes. So you take these into income in the past by virtue of doing an amended return if you're an S corporation or a C corporation, or potentially an administrative adjustment if you're a partnership in a future time period. But these are taxable in a way. You don't get to take a deduction on for the wage expense in the amount of the employee retention credit. Monetization. It says here, and I haven't really changed this bullet because it hasn't changed. Refund claims are taking 6 to 12 months to be issued by the IRS. I would say that's still true. For both 2020 and 2021, I would probably say it's more on average 9. There's less of that 6 months, but I have seen some hitting 4. But it takes time. One other question that I always get invariably is I work with a PEO. And so because I work with a PEO, they have to file, not me. That's correct. Generally speaking, the only obligation on the part of the taxpayer when they work with a PEO, who basically what a PEO does is it has the employees on its EIN and it has to file on behalf of the taxpayers who qualify for the employee retention credit. They have to do it in their own batch filing. And so the credit goes to the PEO, not to the taxpayer individually on a 941. And so that's an arrangement between the taxpayer and the PEO, and then the PEO and the IRS. If the PEO, for some reason, owes a tax liability to the IRS is perfectly able to pull from that employee retention credit issued, even though it's related to some other taxpayer, from the PEO. So you're going to have to work with your PEO closely in terms of applying for the employee retention credit, understanding when they are going to do the next batch filing for 2020 and or 2021. And they may get to a point where they're not going to do anymore. So I would get into that conversation quickly. R&D tax credit. The point here is that you're not allowed to stick the same dollar in 2 tax credits at once. And so if you're claiming a research credit, you're claiming an employee retention credit, it's very important that you get the math right and that you understand that the ERCs are calculated on a gross wage, the R&D credits are calculated on a box 1 W-2 wage. So there's a large portion of ERC that never hits the amount of wage that goes into an R&D credit calculation anyway. I'm just reading a question here. When qualifying for gross loss, do you only have to qualify for the quarter that you are? Yeah, I'll get that in a second. Point being, you can't stick the same dollar in 2 credits. So we have a very good methodology with respect to allocating as much to ERC and away from R&D as possible. But even if you allocate it away from R&D, it still counts as a qualified research expense for R&D in the next year when you're looking at your base amount for R&D. So it doesn't fall out of your base, it stays a qualified research expense. Let me go into the chat here and see if I can see some of these questions here. When qualifying for gross receipts loss, do you only have to qualify for the quarter that you are applying for credits or across all quarters? Excellent question. So let's say, for example, in 2021, you want to look at quarter 2 of 21. You look at quarter 2 of 21 compared to quarter 2 of 19. If you have a more than 20% decline, you therefore qualify for the employee retention credit. If you don't, you have the option to look at the prior quarter as well. So you can look at Q1 21 compared to Q1 19. And if you have a 21% decline there, you just qualify for quarter 1 and quarter 2 because you can use the current and or prior quarter for purposes of qualification in 2021. In 2020, there's only 1 credit that is reported over 4 different quarters and 3 separate 941X filings. So generally speaking, you'll kind of max out on 2020, even if you qualify for 1 quarter only, but you'll still at least get 2 quarters in any time you qualify for at least under the gross receipts test. If you're qualifying under a government order test, you only qualify for as long as that government order was in place. Okay, great. I'll leave it at that. Why don't we move on to the next? Oh, statute of limitations, most important. Yes, clock is ticking, right? So this is our advertisement. If you want to look at 2020s, you have until April of 2024 to file. If you want to file for 2021, you have until April of 2025 to do that. I'm just reading some more questions here. Okay, so it says, if it impacted one area of your business, we're in food service equipment, which was impacted by restaurant restrictions, you offset the by other areas for which you would qualify. Okay, so for example, okay, so you need to look at your gross receipts holistically. So you look at the entire gross receipts for the organization. If one part of the area, one part of the business has a more detrimental effect on its gross receipts due to restrictions on some of your customers, like the restaurant, if you have another part of your business that's still propping up your gross receipts, you won't qualify under the gross receipts test. But if a government order affects your business directly and it only affects one area of your business, but that's a more than 10% part of your business, and you can show an overall some kind of detriment there, which would be good to be measured through like hours spent on that activity in 2019 or revenues associated with that activity in 2019, then you should be able to include everything. But to answer the question that I think they're asking here is you look at the overall gross receipts of the organization as a whole, even if it's coming from multiple business lines. Okay, let's go to next. Polling question 3. And I hope I'm not talking too fast so we get done too quickly because I want to make sure everybody gets their CPE. I've been accused of speaking quickly, believe it or not. Did your business apply for and receive a PPP loan? Yes, round 1, yes, round 1 and 2, or no. And again, I'll just repeat what Carolyn was talking about. PPP, Payroll Protection Program funding forgiveness is not treated as gross receipts for purposes of the employer retention credit. Carolyn, what am I not talking about? Anything?
I think you're hitting it. I can't wait to hear you talk about documentation and
Yes.
the IRS notices and warnings that are unprecedented.
Yeah. Well, I may be tired by that point. I may ask you to. Well, we'll see. I've been talking a lot, so you never know. All right. Let's see if we can get through this polling question. Okay. No. And so interesting. I haven't seen that many who didn't get PPP, which means that these businesses were either small, well, didn't have any declines, or were set up in like 2020. So it's interesting. It just gives me a sense of who might be on the call today. All right, let's go to the next one.
Whoops.
ERC required documentation. Okay, so let's talk about what we need to do a project, or your provider needs to do a project. And also, I will just encourage anybody who's listening to this to avoid the contingent fee ERC consultancies for the most part. Some of them are supported by some larger organizations like CPA firms that are doing it. But if you can work with a CPA firm directly, I would just encourage it because the fees are generally lower and the IRS defense and documentation will be stronger. But in order to analyze what your business might, for what it might be eligible for ERCs, we like to look at obviously your prior 941s. Brian Demps, I'll get to your question in a minute. I see that right there. We're going to look at your prior form 941s. Let's figure out how much you paid your people and how many people you had. 2, we're going to look at your org charts so we can exactly understand who owns the place, how the organization changed, if there's a control group or not, and if there are any of the owners who are employees on the W-2s. We're going to look at your number of full-time employees. So full-time employees for both 2019 and 2020, but really we're focused on 19 to understand whether or not you have more than 100 or 500 full-timers on average in 2019 for purposes of the 2020 and 21 credits, respectively. Let's go to the next. This is what we do. Number 4, government mandates. I'm going to get to both these questions that just came through. Government orders. Yeah. Identify all the company locations where government orders. This is something that we will generally do for our clients. What we do is talk to you about how you experienced the COVID time period of orders. If you're a school, we talk to you about like what services you couldn't offer in addition to having to teach virtually. If you're a church, we talk about when you could not provide services or weddings or some of the other stuff. If you're a restaurant, we talk about like when you couldn't do in-room dining. It's different for every place, and it's also different for every location because these are generally specific to the location and the industry. If you're a business from South Carolina telling me that you have a restaurant restriction in the third quarter of 2021, I know that's not right. Or if I have to review that, I know that's not right because many of the southern states were made a point of lifting the government orders earlier, which is perfectly valid and part of that, but it just, unfortunately for ERC purposes, does not allow you to qualify as easily. PPP data, we're going to want to understand your covered period for the PPP loan, and also we're going to want to understand exactly when you got forgiveness and to what expenses those wages, the PPP funding went. So I got a question here, and it's not really covered too much in the slides here, but I will cover it right now. I alluded to it earlier. It's called a recovery startup business. If, for example, a business started in mid to late February of 2020, and that was its first time it had gross receipts, if it has less than on average $1 million in gross receipts over a certain period, measuring period, we talk about the employee retention credit existing for 2020 and the first 3 quarters of 21. There's actually a separate credit for quarters 3 and 4 of 2021 called the recovery startup regime that has a maximum credit of, I think, $50,000 in quarter 3 and $50,000 in quarter 4. So you can get $100,000 of credit, and it's much easier to qualify for if you're just a startup business. I would say most startup businesses that began in 21 or 20, at least after February of 20, will probably qualify for this. And it could be an extra 100,000 to think about. Okay, the question I got as well was, can you clarify the automatic qualification for the succeeding quarter if the preceding quarter qualified based on gross revenue decline, please? Yes, I can. Okay, and I'll even do it slower than I read that. This is 2021 credits only. So let's say, for example, I am a business and I look to my first quarter of 2021 and I compare that to the first quarter of 2019 from a revenue perspective, gross receipts perspective, and I do not have a 20% decline. I have an 18% decline. Okay, you don't qualify, but I have the option electively to look to the prior quarter compared to that same prior quarter of 19. So for quarter 1 20, I can actually look to quarter 1 21. I can look to quarter 4 20 compared to quarter 4 19. And if I have a more than 20% decline there, then I automatically qualify for quarter 1. Now let's go forward in time. If, for example, I have a quarter 2 2021 comparison to quarter 2 2019 decline of, say, 25%, then I qualify for quarter 2. I also qualify for quarter 3 as well, because in quarter 3, I can use the prior quarter. So in some ways, if you qualify in quarter 1 or 2, based on the quarter 1 and 2 gross receipts, compared to quarter 1 and 2 gross receipts in 2019, you automatically qualify for quarter 3 as well. The real way it's written is you can look to the current quarter or the prior quarter compared to those exact same quarters in 2019. All right, let's go to the next one. Okay, W-2 data. Not too different than we see from an R&D study perspective. We want to understand the employee ID, who the employees are, potentially what their job title is, because especially for these larger organizations where we have to identify individuals who are paid not to work, sometimes that's done based on a department or job title perspective. So the more data, the better. Also, to cross-reference it with the R&D credits, we request all this stuff. And whether it's ADP or any other payroll companies, they should be able to give you this data such that we can understand exactly what each person was paid from a gross perspective. The one thing that everybody always forgets to provide that we end up doing at the very end of the project is you can also include, to the extent a person did not get paid $10,000 in one of the eligible periods, the amount of employer paid healthcare in addition to the gross wage. And so you can one theory for maximizing your credit, or one strategy, is to include the amount of employer paid healthcare costs with each employee in our data by paycheck date. And so that's how detailed we go. when we look at this stuff. So both wages and healthcare costs can be included in the amount that goes into what's known as qualifying wages if you're an eligible employer. Okay, let's go to the next one. Importance of documentation. Excellent. Okay, so here we talk about where we're starting to see some stuff. Okay, I wouldn't say concerned, but I would be aware that the IRS is going to be examining employee retention credit claims, even if you have already been refunded your employee retention credit and you're in a position where you maybe had that money and spent it. Look out for that a little bit. What they're going to want to know is what you filed on your original 941. They're going to ask for your basic work papers and how you completed how you filed for the ERC, including the wage costs and the healthcare costs. They want to know the employees who were paid sick and family leave, because that's another credit that they don't want you to claim and claim ERC on the exact same amount, called the Families First Coronavirus Relief Act credit. Basically, it's all the stuff I talked about before, which is pay dates, wages. They want to understand exactly what your government orders were, how long they were in existence, that they're not just OSHA or CDC guidance. They want to have a story that connects these orders to the business and explain exactly how it was having a detrimental effect on the business, especially in the context of companies that have large increases in their revenues. Again, that's going to be a tough story to sell. We have some that make sense when it's affecting a more than nominal portion of the business and we can really show it. And there's a lot of hardship there. But something I've seen is that, some of these places will say, well, I had a bunch of increased costs, just to hire people was harder. That doesn't matter. It has nothing to do with this particular credit. It might be a sprinkle on top in terms of telling the story, but it doesn't have anything to do with your qualification. So increased costs are not a way to get qualified. They want to understand the wages paid to each person. They want to understand how much you got in PPP. All this stuff is part of our deliverable, but they want to understand your gross receipts. They may go deeper and say, give us some of the data that goes into gross receipts. I have even seen them ask for bank statements in order to justify these gross receipts amounts. So if you, if you have audited financial statements, I think they'll accept those, but you never know what exactly they may be asking for. These audits are new, but I would just be prepared to have all of your data ready to go. Both from a financial perspective, both additionally from a legislative perspective in terms of these government orders, but even more than that, from an anecdotal perspective, so you can tell the story of how the orders affect the business in a more than nominal portion of the business. It's going to be most important. So we talked about some of this stuff a little bit before, but let me talk about some industry stuff that we've seen. All right, we talked about private equity. Yes. Definitely, if you haven't considered it and you're a PE fund or you happen to be a portfolio company owned by private equity and you haven't looked at ERC or you thought you couldn't, please do. Law firms. We've looked at a number of law firms who both either had the gross receipts declines or did not have access to practice, especially in the litigation context, in courts due to the fact that the court closures were affecting them. Now, you think, well, the court closure is not in effect on my actual business. In this case, it is because the location of practice is often within a government building that was shut down. And so by definition, the courts become the location of the practice of the law firm. And so it's treated as a government order on them. And so you'll see reductions in the amount of jury trials that could be held. Some things had to go to Zoom conferences, which caused a slowdown in the ability to settle or even deal with particular matters before the court on the docket. So law firms are a rich area for purposes of looking at the employee retention credit. Tax exempt entities. Don't forget that tax exempts can qualify for the ERC. A lot of what we see in this particular area for these nonprofits is their fundraising events. All were to have taken place in person over certain periods of time in 2020, and they could not take place due to the fact that they had to go virtual or people couldn't be in a hotel room or a conference center. That location of the conference center, et cetera, might be good enough as the prohibition on having those group gatherings there might be enough to say that the tax exempt entity had a partial shutdown due to the fact that it didn't collect enough of its normal fundraising that it normally would have in 2019. Again, facts and circumstances, but it's a potential area of investigation. Government contractors, this is interesting as well. You have to understand exactly how you're paid by the government. One of the things the government wants to avoid is funding government contractors and then having those government contractors claim an employee retention credit on the wages funded by the actual government entity providing the government contract. So you need to look at whether it's a firm fixed price, time and materials, or cost plus, and make an analysis there. And we can get into some of the specific rules about that, and we'll be happy to talk to you about that. But generally speaking, time tracking data goes along with the analysis of the government contractor to understand what kind of contract their employees were working under, to make sure that even if they are an eligible employer, whether the wages they pay their people are actually eligible for the credit. Last thing, supply chain disruptions. Again, you want to know the location of the supplier, how the flow of goods comes from outside the US or within the US. And again, foreign mandates, yes, can be something that are cause eligibility to occur. But again, I think it's an area where the IRS may ask questions because they haven't certainly affirmatively stated it, that they're accepting this, but we believe under the reading law that you can use them. So I'll leave that at that. All right. Last point. I keep saying last point, but there's always another slide. That's okay. I can always talk. It's just a matter of ERC and PVP documentation. You can't double count. In all of our documentation, we show the funding for PVP wages that go, PVP funding that funds wages. We want to make sure none of those funded wages by PVP go into an employee retention credit calculation. You have generally a 24-week covered period to which you can allocate PVP funding. When that takes place, it's a little fungible to which individuals you can allocate some of that PVP funding just for ERC purposes. And so it's a bit of a science when it comes to making sure you maximize these credits, but you can utilize the benefit of a covered period that is significantly longer than the amount of wages, which are, say, for example, about 8 weeks of wages under a PVP loan, generally for a covered period 3 times as long as that. And so it may not bring down your employee retention credit, but you have to look at it very specifically and get your work papers right, because it's one of the areas the IRS is going to look for more than anything. Abuse and double counting on R&D or PPP. So how to choose a provider? I would say choose us, but beyond that, I would say choose somebody who's not charging a contingent fee. Choose somebody who wants to take the time to not just tell you within 5 minutes whether you're qualified, that they're going to spend time to adequately look at your fact pattern. I would say avoid anybody that says you're automatically getting $26,000 per year. Per employee per year, or you we can determine your eligibility in 5 minutes on a website. That is not where you want to go, because I guarantee these companies won't be around next year. The entire purpose of employee retention credit services that we've offered, and I think any reputable firm has, is to provide a service to help you maximize a credit to which you're entitled, not to which we're entitled as a fee. Yes, there's a fair fee for doing the work, but we're always looking for other opportunities for you. And for us to work with you. And we would certainly never want to burn a relationship just by looking for one ERC thing. Our goal is to help you work with the best provider. It doesn't have to be us, but I would just suggest work with an actual CPA. So from a client approach perspective, last point, who knows? It is, we're going to assist anybody and scope this out for free for you, because it's incumbent upon us to understand your fact pattern. And why would you want to pay anybody to do too much work, especially when you might not get a credit? So we talk to the company, we explain the law to them, we understand how many employees that they had, we will give them an estimate of what the potential benefits might be, and we will never charge a contingent fee. We will only do a flat fee based on the number of employees in the calculation, and it tends to get successively cheaper for each of the succeeding qualifying ERC periods due to efficiencies of scale. But the entire purpose is for us to get comfortable, because we sign this 941X for purposes of filing the amended return, so you can get this amount. We're on the hook with you. We're taking an approach that you would more likely than not qualify for this credit, and that's what our signature on the return means. And so that's why it's so important for us to analyze your fact pattern, and if we're comfortable, we believe you should be comfortable that you qualify. And And that's that. So I would suggest the following. Good. Polling question 4. Have you applied for the employee retention credit? I guess this is the big one. Let's find out. No, but I'm interested in a follow-up conversation. No, my organization does not qualify. Yes, all set. Or yes, now we may need help with the IRS audit. Or perhaps the last answer is no, I don't want to ever hear this guy talk again. So we'll see what you come up with. We'll leave it open for a few more minutes, and then we're getting close to finishing. And thank you all, by the way, for attending. CPE is important, but we're intending to make this beneficial to those and sort of cut through the noise, as I said, around employee retention credit, and cover a lot of stuff quickly for you, so that you can, I don't know, pick the right provider, whoever it is. All right, what's the answer here? Oh, maybe we don't know. Doesn't matter. It's all right. Well, is that it then, Maddie, Lindsay? I think, are we finished?
Yeah, I think that is great. Marty, Carolyn, thank you guys so much. I am going to pull up that slide with a QR code for everybody to be able to sign up for the remaining sessions. You know, if you liked what you heard today, or maybe you didn't, no, we know you did. Feel free to sign up for the rest. I'm going to pull it up here for you shortly.
We're going to take a different tack every time, because there's stuff coming out from the IRS. There's stuff we see with taxpayers, and we're going to talk about our experience every time with one's documentation, one's like what we're seeing from the service. We're monthly to see what's going on with the employee retention credit. So if you're thinking about qualifying or thinking about having somebody look at it, just feel free to dial back in, and we'll talk about what the latest developments are.
Yep, exactly. It's going to be different each time. Even though we don't have anything past September, we will be releasing these sessions as, you know, more topics come about. So we'll take it through the end of this year, and who knows, maybe even into 2024. So thank you both so much. And we hope to see the rest of you on our upcoming sessions.
I appreciate everybody giving me hearts, thumbs up, and claps. I feel good about myself. So thank you all. Take care.